Hi, good morning, everyone. I'd just like to take this opportunity to say thank you very much to the conference organizers. It's been my favorite event of the year, and looking back over some of the stuff we've been doing, it's definitely stood out as a really interesting conference. So thank you very much for the organizers. I've been asked to talk about cash on ledgers, so central bank digital currencies, fiat on blockchain. You see and hear a lot of words in the media, and sometimes it's miscommunicated. Sometimes people use words very loosely. I hope to kind of clarify some of the terminology and the concepts so that to prepare for the real experts who are going to come on stage at the panel a little bit later. So with that, let's talk words. Let's talk terminology first. The way I like to think about money is by issuer. Who's issuing the money? So of course we understand that central banks issue money. Some people call that M0. Some people call that the only form of real money or fiat or something like that. Central bank money is issued electronically already to participants of interbank payment systems, real-time gross settlement systems, RTGSs. I think we might use some acronyms a bit later on, so I'll try to explain them now. And central banks also issue physical tokens in the form of banknotes and coins. And of course, I'm generalizing here because it is different in different countries. What backs central bank money differs by jurisdiction. Commercial banks also create money, sometimes called M2. When a commercial bank writes a loan, it creates deposits. And those deposits are used by people, by companies, to make payments, to extinguish financial obligations, and settle. And then there's the what's called in some jurisdictions the e-money companies. So think PayPal, think Venmo, think possibly even what was mentioned just now, BitHum. It's money that's backed one-to-one by deposits sitting in a commercial bank. So as an e-money institution in the EU, you have a company, you open a bank account with a commercial bank, and then people pay money into your kind of custody account at the commercial bank, and then they get whatever the token it is that they want to buy from you, whether that's money on cards for the metro, or whether that's wallets based in your app that's used for kind of peer-to-peer sending of money, etc. So you have different issuers with different credit ratings, different risk profiles. I suppose central bank money is the most risk-free form of money. A central bank cannot go bankrupt in its own currency. It can continue to buy assets with money that it creates. So that's how we think of it. And until Bitcoin came along, until blockchains came along, mainly these were done with an account model, so looking at the bottom row here. So that means that the entity, whether it's the e-money entity, the commercial bank, or the central bank, keeps a list of participants and how much balance they have, and it's an account-based model. And when one party pays another party, there's a debit and a credit, a plus 10 and a minus 10 to move that money. Now Bitcoin comes along and confuses things a little bit. So what I'm describing here is tokenized on ledger, and it doesn't really matter. We're going to talk about different types of technologies, but really this is potentially a bearer asset. It's who has control over the writing of the transactions. And in Bitcoin, of course, the control is shared. You have a private key which allows you to sign a Bitcoin transaction, and then the miners have to pick it up to have it recorded. So in some respects, you can call that a bearer asset. But really, I'm talking about a blockchain, transactions or balances recorded on some form of blockchain system using private keys to sign and authenticate. And so we call that tokenized. I guess other people use different words, but that's hopefully that's helpful in terms of how you think about these things. One of my favorite pictures came from the Bank of International Settlements, the BIS, where they produced a money flower. And this is a chart where you kind of have four axes, four interlocking circles where at any point in that you can have any combination of the different things. And the characteristic, what they're trying to do is find terminology to define money based on its characteristics. Okay, and its characteristics are the circles. So working from left to right, accessibility. Who's allowed to hold the money? Is anyone allowed to hold the money, or is it a select club of people or entities who are allowed to hold the money? So that's accessibility. Now, cash is really accessible. Anyone can hold cash, and no one can stop you. As long as you have a pocket, you can hold cash. And cash can move across borders. You can hold it here, you can hold it there. Cash is probably the most accessible physical form of money. And Bitcoin may sit there. Anyone who can create a public-private key pair or use some software and wiggle a mouse can create a Bitcoin address, an account, and I suppose own some Bitcoins. Bank deposits also sits in that circle. I would argue slightly less accessible than cash because banks get to deny you an account. Whereas with cash, anyone can hold cash. So there are some nuances there, but that's probably the best place to put it. So that's accessibility. Who can hold the stuff? Digital. Hopefully that's clear. It's either physical tokens or it's in electronic form. That's the blue circle. Central bank issued. So we talked about that just now. The green circle. Who's issuing the money? Whose balance sheet does it sit on? Whose liability is it? Who owes you at the end of the day? Remember, when you have a deposit with a bank, you consider that your money. The bank considers that a liability because it's got to pay out to you on demand, subject to a whole number of constraints, daily limits, ATM actually having money in the ATM, not being allowed to make big payments without some additional forms of authorization. But who issues the money? Is it a central bank, which is the important thing, or is it not a central bank? And if it's not a central bank, is it a commercial bank? Is it e-money? Who's the issuer? And with Bitcoin, who is the issuer? And then finally, token-based. I guess this is. We'll talk about this on the panel. Token-based, I suppose, is as opposed to account-based. So in an account-based model, someone runs a set of accounts which has your name and it has the balance that you have with them. In a token-based model, the money sits as a token on the device. So with physical cash, that's easy to understand because it's tokens, it's physical notes and coins in your pocket. In the digital form, I guess it's a bit more like sometimes for staff canteens, you load balance onto a card electronically. If you lose your card, you lose your money. Sometimes that happens with transport. We had the Oyster card in the UK. If you lose your card, you lose your money. So that would be more of a, and the money is represented as a token on the device. And there are some interesting initiatives around mobile money along those lines. So hopefully now you can think along 4 dimensions, and any form of money you can characterize by saying, is it in that circle or out of that circle? What we're going to talk about sits within the central bank money circle. So this is we're talking about central bank digital currencies. So it sits within the green central bank circle and the blue digital circle. But there's still many different types of money within CBDC. So who's allowed to hold it? Is it available to the public? Can someone with an app on their phone access the central bank's money digitally or not? Is it token-based, where the value lies at the endpoint, or is it account-based? And if it's account-based, how do you deal with identity? There are all sorts of thorny issues there. So that's framing the terminology. We'll be talking about the central bank issued digital currencies. We use the word wholesale. Wholesale meaning only accessible to a kind of a select group of participants. Usually, in some jurisdictions, they're called clearing banks. In some jurisdictions, it's anyone who can have what's called reserves, so central bank digital money. And in different countries, in different jurisdictions, that club of participants is different. So, for example, in Hong Kong, anyone with a banking license has an account with the central bank, kind of by definition. They have to. Whereas, say, in the UK, only certain banks have an account with the Bank of England. And these things are in flux. These things are changing. Okay, so another set of words: wholesale, digital, fiat on blockchains. So what I'm going to talk about in just a second, the wholesale bit, I'm saying it's not accessible to households. So when we talk about wholesale central bank digital currencies, that means that as a household, as a person, perhaps as a company, you cannot hold this form of money. But existing wholesale participants can. Existing banks, clearing banks, RTGS participants can. I also want to kind of clarify that we're not always talking about replacing interbank payment systems. People talk about blockchain, ripping out the old system, replacing it with a new system. No, not necessarily, not all the time. It can complement this. It's a different set of books and records with different characteristics. You can record central bank money on a centralized system. You can record a centralized system on an account-based model. You can record central bank liabilities, central bank issued money, on a distributed ledger. You can have these running in parallel. You can use one as a disaster recovery for the other. Not necessarily always talking about ripping out the old system and completely changing it wholesale. And perhaps for this, we're not really talking about a new form of money. We're not talking about inflating the monetary supply. We're talking about a new medium of record with different properties. Some would argue better properties than centralized interbank payment systems. But for sure, there are trade-offs, and for sure it's a new book in which you're writing and recording the transactions and the balances. Okay. Just before we go there, what are the complexities with what we call a retail CDBC? A retail CDBC would be one that is accessible to the public. It would be central bank money that you and I or companies could own and access. And there are lots of questions that need to be really thought through, and some are philosophical almost. So firstly, so the central bank already gives you access to their balance sheet through physical cash. So is this digital thing designed to be a complement to physical cash or a replacement? Is there a desire to go cashless? Is the central bank trying to push for cashless society or not? Or perhaps people are already going cashless by their own decisions, by their own activities on a day-to-day basis, and perhaps the central bank sees that the only digital means of making payment are all private sector driven, and perhaps should be a utility. We heard about this yesterday. Perhaps there should be a public sector digital alternative for people to make digital payments. Why should we all be subject to the private sector, to banks and e-money? Really thorny question of identity versus financial privacy. Should identity flow with money? Should you be able to hold electronic money without providing your identity? And this is almost philosophical, and different jurisdictions think different things. So this isn't one size fits all. If there's anything I can take away from the conversations I've been having with people working at central banks and regulators, it's that they think differently, and the local context is different. So really thorny issues with identity and privacy, and then the ability to censor, because of course if identity is linked to money, and that money isn't censorship resistant, then you can really cut someone off from being able to make any financial payment whatsoever if the use of cash continues to decline. Should there be an interest rate? Cash doesn't have an interest rate. I mean, you leave a 10,001 note under your mattress, and it'll stay as 10,001. It doesn't grow. It doesn't have babies and become 11,000. Sure, if you have consumer price inflation, that money can buy you less over time. But there's no intrinsic interest rate to physical cash. Is that a feature or a bug? Was that by design, or is that just you can't really do that with physical cash? And so if you're trying to replicate physical cash in the digital world where you can have an interest rate, should you? What are the implications? Lots of questions, lots of things to think about. Something that comes up a lot: systemic risk. If you, as a household, as a person, now have a choice: do I hold my money with Bank X, or do I hold central bank money, Bank of Korea money? What are the trade-offs? Why should I hold money with a leveraged institution rather than holding a safer form of asset with a central bank? Well, perhaps goes back to the interest rate. Perhaps they offer different interest rates, and perhaps there's a financial incentive to do one or the other. And then what about offline transactions? We all sit in a very digital world, but things do go offline, either through cyber attack or just through natural disasters, poles going, cables snapping due to bad weather and trees on lines and shops not having connectivity and just bugs and glitches. Should there be another form of payment like cash which works no matter what the weather, no matter if electricity is cut, no matter if data is unavailable for whatever reason in that geographical area? So loads of thorny questions, and only then can you answer the question, well, once we've answered all of those questions, then what's the medium of record? Should it be a blockchain? Should it be an account-based system? What should we use? So loads of questions on the retail side. And different jurisdictions are different stages along the path. We'll talk about that during the panel. I won't name any specific names now. So back to wholesale now. So we've done retail. Retail's really complex. Back to wholesale. So this is banks holding central bank money, but having the transactions recorded on a blockchain instead of in a centralized system. So what's the promise? What have we been telling everyone for the past couple of years? Past 5 years, perhaps. So if you represent assets digitally, they can change ownership. It's the faster, better, cheaper arguments. They can change ownership at the speed of email across borders. Of course, Bitcoin doesn't even recognize borders. It's just if you can make a transaction and sign it with your private key, you can make a transaction and sign it with a private key. And potentially fewer steps and costs. Perhaps you can reduce the need for certain types of participants in the ecosystem. Now, I'm not making any value judgments whether that's a good thing or a bad thing, but business models may have to change. So, for example, a specific bookkeeper whose only job it is to keep track of digital assets, well, if the end users, by which I mean the wholesale participants, the banks, if they can keep track of their own digital assets, then perhaps they don't need to pay fees to someone whose job it is to maintain that database. You can have pre-agreed automation, which we call smart contracts. So if this happens, then that happens, and both parties are comfortable that series of logical steps is going to happen, given the inputs, you get the outputs. Pre-agreed constraints. Where can this money flow to? Only here, only there. Special purpose money. Again, I'm not making any value judgments. Is that a good thing? Is that a bad thing? But this is something that we can do with this technology. Atomic transactions seems to resonate a lot. So the concept of an atomic transaction where in one transaction you can create multiple changes to the ledger. So we have assets on blockchains, on ledgers. If we get the money on as well, then you can create individual transactions that maybe changes ownership of the asset at the same time as making the payment. And you don't have to do what we're currently doing, which is an asset moves across one set of rails over here, and the money moves over another set of rails over there, and we've got to do this linking and reconciliation and hope that they both happen at the same time and hope that one doesn't fail or get reversed while the other one happens, so-called Herstatt risk. And another promise, databases are guaranteed to be synchronized across entities, so resulting in fewer breaks and operational headaches. This isn't a retail problem. People don't care about breaks, really. We trust our banks, kind of. But when banks deal with other banks, they have to make damn sure that what they think, what they see in their database matches what their counterparty sees in their database. Now, this is really different to the Bitcoin white paper, okay? And that's fine. We don't have to use Bitcoin for everything. We're using some tools, some technical tools to solve a different set of problems here. So, you know, most of us, I think, have read the Bitcoin white paper talking about essentially censorship-resistant electronic cash that travels over the net without specific intermediaries, without specific financial institutions. That's not the problem we're trying to solve in the wholesale space. So the three forms of cash on ledger that are emerging: central bank issued cash with some characteristics, lowest risk, but because we're talking about wholesale central bank money, it's the least accessible by definition. Private sector issued cash on blockchains. So backed by either whatever backs your deposits at a commercial bank, the balance sheet, the assets, or these tokens could be backed by assets held elsewhere. So for example, a commercial bank could hold some reserves at a central bank and issue tokens one-to-one on the basis of those reserves. And perhaps people might trust those tokens slightly more than if they weren't backed one-to-one by central bank money. And then finally, e-money. Perhaps that was what we talked about this morning with BitHum. Perhaps even that's what Tether's having a go at. But this is tokens backed by deposits sitting in a commercial bank. And as I mentioned at the beginning, there are different trade-offs. This year seems to be a pivotal year. A couple of years ago, corporates got, financial institutions, corporates, companies got used to data being sent across blockchains. They're getting comfortable with that concept. Last year, we started seeing for the first time financial assets being recorded on blockchains, on distributed ledgers. So here at R3, we had Commerzbank issuing commercial paper, short-term debt from a corporate, recorded on Corda. Right? We're using a different medium on which to record these things. Nothing magic about that. But assets are slowly getting on ledger. But if you only have the assets on the ledger and not the cash, you still have to revert to the traditional methods of payment for the settlement, for the payment. You have an asset that moves, you need to make a payment. And it'll be much better, we deliver on the promise much more effectively if there's cash on the ledger as well as the asset, because then you can get these atomic transactions. I think this year, this is a prediction, I guess, I think this year we'll see commercial bank issuing money on ledger, whether you call that IOUs or scrip or certificates of deposits, and perhaps even some form of central bank money on ledger, probably wholesale, probably not retail. We've seen retail before with the Central Bank of Ecuador. As far as I understand, that's been pulled. That wasn't successful. But perhaps this year we might see that. But remember, 2 years ago, we were saying it's 10 years in the future. Last year we were saying it's 5 years in the future. Now it's like it's getting pretty close. That's the story. Why are central banks interested? The rationale differ. And we'll talk about this on the panel. Different central banks have different reasons for wanting to explore putting their money on blockchains. But there are some commonalities. They need to manage the money supply. They need to maintain stability. And they need to keep abreast of technological advances. And what are the benefits? Reducing point of failure risks. We'll cover this. Possibly maintaining control over the money supply. That's the job of a central bank. Reducing the risk of one leg failing whilst the other leg succeeds, and perhaps even driving increased business in the real economy, because that's what we care about. Atomic transactions, I did mention this. So imagine secondary market, someone buys a bond from someone else. These are both banks, for example. The money moves across one set of ledgers, the bond moves across another set. If they're both recorded on blockchains, or interoperable blockchains, or on even the same platform, then you can create one single transaction which does both things at once, resulting in fewer breaks and fewer operational risks. And on Corda, that'd be recorded directly on the two participants' ledgers. If you use something like Ethereum, it would be recorded on all the Ethereum computers, unless you used another privacy layer on top of that. And there's potentially better regulatory reporting on that. In terms of progress, in terms of public progress, I point you to the reports that have been issued by the central banks. So with Bank of Canada, they're on phase 3 of a project. Phase 3 is about getting equities and central bank money on ledger, on distributed ledger, and testing out this delivery versus payment and seeing actually what's the business case, what's the potential impact. Ubin, we can probably talk about that because Stan, who's going to be on the panel later, was a key architect of the Monetary Authority of Singapore's experiments. And in Hong Kong, we've been involved with Project Lion Rock, which is a similar idea. But there we tried paying coupons on bonds. So you mark the bond as coupon paid at the same time as making the payment, rather than going to separate systems. So R3 have been involved with all of these projects, and all of these, at some stage, have been working on Corda. My time is running out. I'm going to skip through why Corda seems to be the platform of choice, and increasingly so. You can take photos of this and tweet this, and use the hashtag Corda if you want. I won't read this out. So to summarize then, what are the questions? You hear central bank digital currency, you've got to ask them questions if it's not clear in your head, right? What format are we talking about? Electronic or physical? Well, central bank digital currency, of course it's electronic. Who issues it? When talking about digital cash, that's the question to ask is who's the issuer? Is it the central bank? Is it the commercial bank? Is it e-money? Or is it cryptocurrency? Kind of not issued by any, not sitting as a liability on any entity's balance sheet. Who can hold it? And it goes, that's the accessibility question. It goes from anyone can hold it to most people to just a select few participants. And then how are the payments recorded? Are they recorded in accounts, or is it more of a token-based model where the money sits on the end device? And of course, there are nuances. Sometimes it's a bit of both. Like Bitcoin, is that a token model or is that an account model? Well, you have a Bitcoin address, which kind of feels like an account. And that account has UTXOs. It has tokens that represent inbound money that's come in. But those accounts aren't centrally held. They're held by, as we've talked to death about, a whole bunch of computers, 11,000 computers, some more useful than others, some are miners, some are not. So there are nuances, and it's not perhaps always binary. So with that, thank you very much.
All right.